Hello. All right, we're back. This is episode 7. This is Dyron Bush, the CEO of Theogony Financial, and this is my podcast. It's called Mechanics of Money. Okay, so first, let's get the formalities out the way. First, we're going to go over this podcast is for entertainment purposes only, does not constitute financial advice. Always consult a licensed financial professional before making investment decisions, and these are strictly my opinion. Please, please verify the validity of what I say. Okay, so let's move on to the next item, right? And the next item is I'm pleased again. I'm moving closer and closer to graduation in my grad school in the MBA program. I want to send a shout out to my team. I'm part of a group in my MBA class. It's a financial. I'm taking a financial management class. It's the second class to last class I'm taking. Um, and our group has done so well that we decided to name ourselves, right? I brought the idea and said, hey, look, we're doing so well because this is literally the best group I've ever been a part of. No slight against the other groups, but this group can basically move autonomous. This is the first group I've ever seen that can kind of move without little to no instructions, as if we all know what to do. We're all professionals, right? So we came up with the name. The name of our group is called Excellence Unleashed, right? And we've been able to make perfect scores on all of our assignments. So I'm really excited, and I'm glad to be part of the group. I want to say hi to all the members of Excellence Unleashed. Next, we're going to talk about what are we going to talk about? We're going to talk about the tools, the taxes, and the truth, right? Again, right now we're going to talk about the tools and the truth. Now, what you see here is a depiction of what's going on with the automobile industry. So let's talk about it, right? Let's talk about what's going on with the automobile industry. Delinquencies are climbing at a pace, the fastest pace since the 2008 crisis, right? Subprime, hardest hit prime, showing this subprime loans are showing stress, right? High interest of 8 to 10% prime, 14 to 20% prime, subprime, and falling used car prices, negative equity, and there's also job market stress. We're going to talk about that. So let's talk about the credit crunch, right? Banks and lenders are tightening standards and lowering the LTV, stricter verifications and fewer approval. So we're going to discuss that in a minute. The ABS loans market is showing a lot of stress. Spreads are widening. Investors are demanding higher risk premiums. The ABS loans, if you don't know what an ABS loan is ABS loans are asset-backed securities created when lenders bundle the auto loans and sell them to investors with repayments and funded by borrowers monthly by borrowers monthly for excuse me funded by borrowers monthly car payments. Okay, I'll correct myself, right? Defaults are rising because of inflation, and high interest rates are strained household budgets, making it harder for borrowers to essentially subprime ones to keep up with the payments. At the same time, falling used car values reduce recovery of repossessions and create increasing losses from investors. Repossessions are up. Lenders are recovering less per vehicle due to weak auction value. high rates and lower affordability. Lower affordability, more defaults, repos, and APS stress. The APS stress is on the lenders, and they have tightened credit. Lower prices, pressure on auto manufacturers. The key to monitor is the subprime delinquency rate, which is 7% and climbing. And the ABS spread is widening. Let's see, the repo lot inventories are swelling, right? How about that, right? The debt trap spreading wide beyond subprime. And for the macro, the auto sector's weakness adds to the recessionary drag. Now, the negative amortized car loan, people bought their loans with the COVID stimulus, and now they're upside down on their loans because the car is worth less than when they initially bought it, right? So they're upside down. And let's talk about the bundling of these loans. What does that sound like, right? That sounds 2008 esque, right? It sounds the same thing that was happening to the mortgage-backed securities when we had the subprime crisis with the GFC, right? They bundled these bad loans. A lot of people got bad loans that got took loans out of houses that didn't deserve to get those loans, right? And the same thing, what we're seeing is it's rearing its ugly head again. So now people have taken out loans, taken out used car loans and regular loans, and they didn't really qualify for those loans, right? Their earning is less. They're upside down on the houses too, so they're trying to keep the house so they can't make their car payments. So that's what's going on. One particular bankruptcy that just came is a Tricolor Holdings just declared Chapter 11. Right, it's a used car dealership. It's a subprime auto lender. So that was a shock, right? Well, they filed for Chapter 7 bankruptcy. So the assets listed with the company is $1 billion, but their liabilities is $10 billion, right? So they're upside down. Over 25,000 creditors have been named in the filing. That's how many creditors are going to be affected by this bankruptcy. Okay, so what we have here is a depiction of the commercial and the domestic home market, right? Real estate market. So let's talk about the commercial real estate market. What we have is what they call is a maturity wall. A maturity wall is going to hit in the fourth quarter, and it's going to be huge, right? The maturity wall as it relates to loans coming due. These are going to be CRE loans that are going to be due at the end of 2025, and it's almost $1 trillion. It's $900 million worth of commercial loans that it's going to come due at the end of 2025, right? So, will this be the catalyst for the stock market crash? We don't know. Let's explore a little bit longer, right? Some more stuff. In 2024 alone, about 929 billion commercial mortgage matured, up from the 729 billion in 2023. So you see an escalation. It's going up, right? The delinquency rate for the CRE loans are rising modestly. And as for Q2 2025, the delinquency rate for commercial real estate loans and leases for commercial banks was 1.57 seasonal adjustment, right? Other metrics, according to the Mortgage Bankers Association, otherwise known as the MBA, the fourth quarter delinquency rate for various CRE classes, bank CMBSs increased. For example, CMBS delinquencies jumped to 5.78%, 30 plus days past due, or in REO in that period. Here are the implications of the maturity wall. As loans mature, many borrowers must refinance and at higher interest rates, often with worse lender conditions, lower property valuations, and higher debt services. The true question is, will this credit with credit lines tightening, how are they going to refinance? I only say that to be I only say this to say is that the reverse repo is at 11 billion. At some point, it was at 2.5 trillion, right? So understanding that the reverse repo is at 11 billion, which has a direct effect on credit lines, right? Credit being offered to people. Um, the question is what do people do now? I mean, if the thesis has always been to extend and pretend, right? To pretend that at some point you're going to actually pay these loans off, and you just keep refinancing. But if you have to refinance at a higher interest rate, is that really helping you, right? Or you're going to be able to refinance altogether? Are they going to allow you to refinance now that credit spreads are tightening, right? So some loans may be extended or modified, but there's a risk, especially for properties types for offices and retail, where occupancy and cash flow are under pressure, right? So that less because we're 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 moving into kind of a recessionary period. Banks are going to be less likely to loan to people that have commercial properties and retail properties because they know that the economy is starting to slow down. The reverse repo is down to 11 billion, so that's what we have. The delinquency rate for residential one through four units mortgages as the end of Q2 2025 is about 3.9% of all loans outstanding, NBA. Within that, the serious delinquencies, 90 plus days past due or in foreclosure, are rising. Foreclosures started and filing are up year to year. 2024 properties entered foreclosure in July of 2025. How about that? 11 to 13% from the period before. So we're seeing an increase from one period to the next where more and more foreclosures are starting to happen, right? The foreclosure rate nationally filed is still relatively low. 3,900 housing units facing foreclosure filed in August 2025, but that is worse than a year ago, right? So when you look at it, it's steadily increasing. But when you get a true picture, when you compare it to this year to last year, that's when you see it in vivid relief, right? You really see that there is a real uptick in foreclosures. So the housing inventory is rising, housing prices appreciate is decelerating, affordability remains strained because many owners have very low fixed rate mortgages, and moving and refinancing is costly. The housing crisis, the largest equity imbalance in history. It's the largest equity imbalance in history. Sellers now outnumber buyers by 500,000, right? So many homeowners are upside down on their property tax. That's interesting too when you look into it. A lot of people are upside down on their property tax because the value of the homes when they were initially evaluated for property tax, now the house is worth less. So they're upside down. So they're paying property tax on a house that's been devalued, right? So they are literally upside down on their property tax. They have negative equity. Okay, now we're going to talk about the labor market, right? The unemployment rate and all the stuff that affects um, everything that goes with the economy associated with labor. So first, we're going to talk about the labor market. The unemployment has increased, which has reduced the economic spending and depletes corporate revenue and leads to a firing of workers and so on and so on. So we're going to discuss this, right? We're going to just discuss what I just said, okay? And in the next slide, we're going to discuss this in detail so you can have a visual of what I'm talking about, of what I just said, okay? Now, 48% of credit card applications have been denied. 48%, that's half. That's half, right? Just about. 806 layoffs in 2025 so far, right? In counting. We haven't even hit the fourth quarter yet. 6 million Americans are 90 days past due. So let's talk about the data. The BLS misstated job has had a misstated job report over the last year to a year and a half, up to the tune of 800,000 jobs. Can you believe that? That is incredible. So when when a lot of people had kind of confronted me on this issue, right? They like say, Dyron, you don't know what you're talking about. We're not in a recession and stuff like that. Well, now we know, now we know that, when we have to take a second look at the economy and wait, maybe there was more merit to what I was saying when I was saying we're in a recession already, right? We're actually missing 800,000 jobs, and this has been since the last year to a year and a half. Okay. So that's huge. That's huge. That definitely puts us in the recessionary type condition. Okay. Now with the Fed, bad data leads to bad policy. Okay. If how can the Fed react to unemployment if in fact they thought they had 800,000 jobs that they didn't, right? They didn't have those jobs, right? So they're getting bad data. And with that bad data and with the bad numbers, their reaction time is very slow. They're slowly reacting to what they're seeing. Okay, we're just now seeing the rate cuts, and we'll see. We just had the 25 basis points rate cut. We just had that. ADP revised revision has been made on job numbers for the last 12 months. Let's see what else. With the tech sector alone in 2025, 144,000 people impacted by layoffs across roughly 533 tech organizations so far this year, right? According to other tracking sources, over 209 employees have been laid off across 1,300 companies so far in 2025. The U.S. cuts spiked in August 2025, about 86,000 jobs cut announced, a 39% increase over July, right? So we had a 39% increase, so it's accelerating. The job cuts or layoffs are accelerating. This appears to be a largest August number since COVID. So since COVID, we all know that a lot of people had to work from home with COVID, and a lot of jobs were cut. So in biotech, layoffs continue steadily. Fierce Biotech reports about 10 companies in September making cuts versus 26 versus the 26 in August. So, I guess that's when this article was written, the 26th in August. So yeah, this is quite interesting, right? And we're going to discuss this further in the next slide, and I'm going to give you a real vivid idea of what I'm talking about and what is happening in the economy. Okay, now this is the slide that I was talking about that we're going to discuss later on in the podcast, right? What you see before you is what they call a doom loop, right? We're going to go over it in a second, but let's go ahead and talk about this doom loop a little bit. Not specifically yet, but we're going to talk about it in a minute. So let's talk about the job and labor market a little bit in the economy with unemployment. More people are looking for jobs, and there are no vacancies available. This doesn't bode well for those who are graduating and seeking jobs that are literally vanished. So people are graduating and they have the diploma in their hand, but there's no job to match their diploma. So what you have is a divergence that's happening right now at the same time, where you have jobs being taken away by AI, and then you also have unemployment and layoffs because of economic problems too. So you have a twofold diversion going on at the same time, right? And people are coming out, with the expectation of getting jobs, and it's very difficult. It's very difficult, Uh, then next, we're going to talk about the unemployment rate number, right? We're going to talk about that when people argue about whether we're in a recession or whether I was correct when I talked about we were in a recession a year and a half ago or 2 years ago, right? So, and again, the reason why I said we were in a recession is because they recalculated what a recession is, right? So it wasn't so much that I was wrong. They actually changed the numbers to match the political reasoning, right? That they, it wasn't, it was political expediency to say that we weren't in a recession when we actually were. We were in a recession, right? So so according to the Keenan Institute, they have the unemployment rate at 19%. Believe it or not, right? 19%. So people scoff at that. What they're doing is, in that calculation, they're including, which is a number that's often left off of the unemployment. And it's very convenient the way they leave that off of unemployment. There are a large number of people that are unemployed but have stopped looking for a job, right? They count too. You have to include those people, right? I mean, they're unemployed, right? They just became so disenfranchised with the process, disenfranchised of looking for a job, getting turned down. They just literally dropped out of the rat race altogether. Okay, so but to be conservative, and again, this was the Keenan Institute, which is well respected, said the unemployment rate is around 19%, but the real numbers probably sit somewhere around about 8 to 12%. Now, again, if you include the people that have stopped looking for a job, and that is an important number. You have to include them as well. You don't have to, but you really don't, as the Keenan Institute points out, you really don't get the true picture of unemployment until you actually capture the people that stop looking for getting a job. And it's going to be a lot larger, too, as more people start graduating, as we start coming more and more towards the end of the year, towards graduation. They're going to have more people looking for a job, but is there going to be a job there for them? It doesn't look like it. It doesn't look like. So thus, it's going to be more people unemployed. So let's talk about this doom loop, right? I depicted the doom loop. So what we have is, if you look at doom loop, you look at unemployment. Then first you have unemployment, right? You have people that have been are unemployed right now, and then what happens is that because they're unemployed, their ability to spend money in the economy has reduced the economic spending, right? Which is, you see that in how Florida beaches are empty. Vegas, all you have to look at Vegas's tourism numbers. A lot of people don't have a lot of discretionary spending, whether it will be with housing, whether people are upside down with the property tax. A lot of these loans coming up in 2025 in the fourth quarter. So people really don't have a lot of discretionary income. So what happens is this decreases corporate revenue, right? It really affects their bottom line. So corporations are not making as much as they used to, right? So what do they have to do? They have to lay off, right? So you have mass layoffs. 25,000 people laid off by Amazon, right? And so on and so forth, right? Along those lines. So then what happens? We follow this loop around, and guess what? So we're right back to unemployment, but what we have now is more unemployment, right? So we have more unemployment, so the process goes and it accelerates. See, the light has been lit. The fuse has been lit on this. We're already locked into this process, right? What I liken this to, if you've ever seen this on YouTube, look it up, to a perpetual motion machine, right? It has to be a catalyst that starts it, right? Once you start this perpetual motion in motion, then the energy is not necessarily limitless. We haven't got to the point where we can make limitless energy, but you see these different devices that people make that once the catalyst starts it, it keeps going, right? And that's what the doom loop is. The doom loop is a perpetual motion machine, right? So you have more unemployment, more reduced spending in the economic spending. You have more decreased corporate revenues. You have more layoffs. And that's what we're seeing month to month. We're seeing more layoffs. It's increasing, and even more so when you compare 2025 to 2024, right? It's quite interesting. So, but again, it's called the doom loop. All right, now it's time for final thoughts. We're going to talk about different things here. One of the things we're going to discuss is that I'm the CEO of Theography Financial. You can get to my website at www.taxplan.today. You can email me at Dyron Bush, Dyron Bush at taxplan.today. And you can also visit my blog, which is on my webpage, again, at the taxplan.today, and it's called The Ledger of Life. Okay? So let's talk about a couple of different things, right? We talked about the economy. We talked about the automobile loans, delinquencies, mortgages, and mortgages, commercial and private real estate problems as well. So what we have, let's see what's going on with the banking sector too. So we have mass layoffs in the banking sector. Now, what is interesting is that UBS is one of the companies that's having mass layoffs, amongst other banks as well. You're seeing a lot of banks closing a lot of brick and mortar buildings as well that they own, and you can look that up as well. But with UBS is quite interesting because UBS right now is in a tug of war with the Swiss government right now. If you're not familiar with the UBS situation, UBS bought Credit Suisse, right? They took over Credit Suisse. Now, understanding Credit Suisse situation, which is a big financial institution in itself, is that Credit Suisse got caught in the Archegos debacle, right? Where the gentleman lost billions of dollars within 2 to 3 days. I think 10 to 20 billion, it might be even more, that he lost within 3 days, right? It was a family office. He was trading illegally. He was trading uh, financial institutions similar to Credit Suisse and other banks were trading for him because he was a family office. He could only trade a certain amount of money or securities, but he was using the banks by proxy to be able to trade more, right? And he got in over his skis, and Archegos collapsed. So thus, Credit Suisse was starting to teeter a little bit, and the Swiss government gave UBS money to take over Credit Suisse. The problem is that UBS didn't know that Credit Suisse had so many toxic assets on their balance sheet. So that was a problem. That was a problem. So the Swiss government is basically telling UBS that they have to put up more capital to cover these toxic assets. But the problem is UBS doesn't have the capital to cover it. That's the realism of the situation, right? And that's how desperate the situation is. Now, UBS's financials are in fact larger than the Switzerland's government, right? GDP. Just imagine that. So you see how nervous, you see the crux of the situation, how nervous the Swiss government is right now, because if UBS implodes, then so will the Swiss government, because they'll be left footing the bill to cover UBS. So, and something similar happened to HSBC. They lost a lot. I think it might have something to do with Evergrande, but I know they lost billions of dollars in China, and they're in trouble. You also have a Spirit Airlines. Spirit Airlines has gone bankrupt. Florida beaches and Las Vegas are basically looking like virtual ghost towns, right? If you look up and see how the tourism is going in this area, it's definitely on a big downturn. So we'll talk about China. China's the economic model is showing signs of strain, balancing between growth and tech innovation and more traditional real estate export. And the infrastructure sector is hard. The What we have is Evergrande's liquidators have recovered next to 255 million against the 45 billion that is owed to creditors. That is amazing. That is amazing. Now, in terms of, if you're not familiar with the Evergrande situation, the things has gotten so desperate over there that the Chinese people had actually kidnapped the CEO. The CEO's in jail right now. They actually kidnapped him because he basically stole their life savings. So now, what you see here is I'm going to talk about something different. Um, Track me. What you see here is uh, the Donahue George lawsuit against the SEC, FINRA, and hedge fund managers similar to Ken Griffin. Now, this lawsuit has been going on. It's quite amazing. This lawsuit has been going on for 4 years, 37 days, 8 hours, 16 minutes, and 18 seconds, right? Why is that important? Because all Donahue, this case is very intriguing because all Donahue George is asking all these entities, he's saying, if in fact there's no illegal naked shorting going on, right? Or fake shares being produced, then why can't you show me the blue sheets? Again, the blue sheets, what the blue sheets show, they'll show definitively if there's fake shares being produced, right? They show the second to second transactions that are going on in the stock market. And it's been taking them 4 years, 37 days, 8 hours, 16 minutes, and 18 seconds to still not produce the blue sheets. So let's keep an eye on this. This is quite interesting. If nothing nefarious is going on, if nothing illegal is going on, why can't they just show them the blue sheets? It seems kind of ridiculous that they're not doing it. So one has to wonder. So next we have uh, I have 71 days before I graduate, right? 71 days. All right. I'm counting down and I'm gonna keep you in the loop. The next thing we have here is I'm going to talk about a quote by Warren Buffett. He says the natural course of government to make the U.S. currency worthless. So what does he mean by that, right? Basically, what he's saying is that if you look at the national debt, which is that 37 trillion, which is amazing, right? It's amazing that it's at 37 trillion, right? But just to show you the progression and what Warren Buffett is talking about, right, is that in the 2000s, $1 trillion was added to the deficit every 24 months, right? So let's flash forward to the 2010s. So in the 2010s, $1 trillion was added to the deficit every 11 months. So now we're in the 2020s. So $1 trillion is added to the deficit every 5 months, right? So now that these things are happening with our national debt, to every 5 months, $1 trillion being added, it has a direct effect on our credit worthiness, right? We've just been downgraded. China just has been downgraded. So it's not faring well. It's not looking for the dollar. If you go to the DXY on a stock, the dollar is on the decline. The brick is pretty much the prevailing currency right now. So we have to look at that, right? Is Warren Buffett true about that statement? I don't know. We're gonna have to talk about that. Put make sure you like my video, subscribe to it, and put a comment below. Thank you.